Our speaker today, who knows quite a bit about digital currency and cryptocurrencies, Dave Lemke, who's a CFO at Giddy. Dave, and I just want to share his bio. Dave Lemke is the CFO and Chief Compliance Officer at Divvy. He leads finance operations, reporting, tax compliance, and global information reporting and regulatory compliance. Prior to joining Giddy, Dave was a director at PricewaterhouseCoopers, Trust Solutions Group, serving the asset and wealth management industry out of the San Francisco Bay Area. His clients consisted primarily of private equity and venture capital funds, along with individual owners of portfolio companies. He works closely with PwC's Track software development team and led the rollout of its proprietary software from coast to coast. Dave is passionate about technology and entrepreneurship and has personally coded mobile applications in the Apple and Google Play app stores. Dave is a certified public accountant, member of the ACPA, holds a bachelor and master's degree from Brigham University, and serves on Utah's Blockchain and Digital Innovation Task Force. As we were looking at people who would be a good fit for this, we couldn't think of anyone better than Dave, and we're just so grateful to have him here today. And I think this is a topic we'll be hearing a lot more about over the next little while, and just very excited to learn more from Dave and the thoughts and things he's prepared. So give a big round of applause.
Can you hear me? Can you hear me now? All right. Welcome, everyone. I'd say there's probably a lot of you I guess all of you got lunch already, so kudos to you. My tacos never came, sadly, but I'll catch up later. My name is Dave Lemke. I am the CFO at Giddy. On LinkedIn, when I was trying to promote this, I promised that this would be the least boring financial seminar you've been to. I didn't say it wouldn't be boring, but we'll hopefully keep it a little bit interesting and entertaining, and most importantly, informative and factually correct. If you're here, I'm assuming you have a little bit of interest in crypto. It's definitely a new asset class, and so the whole purpose of this is to bring everyone up to speed. If you've only just heard of it, seen the headlines every now and then, and thought, oh, what is that? You're in the right spot. Like, we'll define all of the crypto terms and bring you up to speed kind of on the history of where we've come from, where we're going, and hopefully by the end of this, you'll feel at least conversant on the topic, and if you're already conversant, then maybe a little more informed about what's down the road and in the future. All right, before we begin, some disclaimers. I am not an attorney. I'm not giving legal advice. I am a CPA, but I'm not your CPA. Always consult your own professionals, and last but not least, this is not financial advice. And in fact, I imagine by the time that I'm done talking about all the headlines, you'll probably be less likely to invest in crypto than you were before the seminar, because it's a pretty risky asset. Okay, so a little bit about me. I went to BYU. I started in 2002. Took the Myers-Briggs personality test, and it came back, said I had no personality, and that therefore you might like to be an accountant. So majored in accounting, worked at PwC, and it was about a year ago when I started getting into crypto, which is when everything kind of hit its peak, and joined the startup that had just gotten funded. We'll talk a little bit more about Giddy, like what we do. I'll do a shameless plug later on to kind of explain what we do. So, crypto is difficult to get into, I think, because it comes with its own vernacular. There's something called crypto Twitter, which is where a lot of the culture of crypto lives and where a lot of investments have happened. And it would not be uncommon to see something like this. Bro, normies were tweeting FUD about the meme coin I aped into. but I went diamond hands on it. Now it's to the moon thanks to whales. HODL is my motto. Raise your hand if you understand at least some of that. Okay, good. We got 4 people in here who can do that. Essentially, this is saying that people who are less familiar with crypto were warning against how risky an asset was, and this person decided to just go all in. They thought the value would appreciate, and they take a long-term view. That is accounting is the language of business. That's translating it. I will try to not use crypto vernacular, or if I do, define them for everyone here. All right. A show of hands, just so I can kind of further familiarize myself with my audience here. Raise your hand if you personally know someone who has ever bought crypto or an NFT or done something. Okay, interesting. So the vast majority of you at least know somebody personally. Raise your hand. Oops. Raise your hand if you have ever bought crypto yourself or bought an NFT. Okay, good. Probably about half. All right. Raise your hand if the company that you work for has ever bought crypto or accepted crypto as a payment. Okay, a couple. All right. And then lastly, this is probably what I'm most interested in. In the next 12 months, does the company you work for plan to invest in crypto or accept crypto as a payment? Okay, not a whole lot of you planning to get in. Okay, that's fine. So let's briefly get up to speed on where we are in the industry with some attention-grabbing headlines. Last year, we were all doing Super Bowl touchdown spikes, dancing around as we saw the market cap of crypto hit $3 trillion. It was, that is small in comparison, like compared to the US government debt of 28 trillion, 3 seems, kind of minute. But it's also was about 25% of the market cap of gold, which has been around since stars exploded to create gold. About this time, the SEC actually approved the first Bitcoin ETF, and so everyone was just feeling great and phenomenal. Since then, that very same Bitcoin ETF has done this. This is its inception to date history since last November. So if you bought into it like I did, then not one of your best investments so far, at least in the short term. I take the long view too. Crypto is down over 60% since last November. And what's worse is that, okay, it's one thing if the price goes down. A lot of entities in the crypto space were lending or running their financial products based on the assumption that Bitcoin would just continue to go up. And that was their collateral. That's what they had in their treasury to be able to support paying out all of their users or to keep their price stable. So when this crashed, it started leading to something else, which was, so this is a stable coin by a company called Terra. And on their balance sheet, they had a lot of Bitcoin to try and keep their crypto token pegged to the price of $1. And so once this happened and certain people started realizing, gosh, I think that this isn't going to last. If they can't pay out, what if there's a bank run, essentially, like a modern day bank run? Well, if it's not clear, that line down at the very end was just in the matter of days. The price plummeted to zero, well, almost zero, and just millions and millions, and in this case, billions of dollars were erased from people who had invested in that stable coin, the blue line. And to make matters worse, the founder is now, there's a warrant out for his arrest because they want to question him and say, hey, was there, did you do the wrong thing? And he's in South Korea. Even here in the US, there's a company called Celsius, who they were a custodial platform. You could open up an account, you could get these great returns, and they too were collateralized by Bitcoin and became insolvent, and they had to freeze withdrawals, and a lot of people ended up losing a lot of money. So all of this bad news, why would anyone in their right mind even want to think about putting any crypto assets on their balance sheet at all? Well, for one thing, if you look at the price of Bitcoin this is just over the past 5 years, you can see that we've got pretty massive spikes, like going from about 4,000 up to 20,000 in the matter of just a few weeks, and then coming crashing back down and then going back up and down and then reaching these enormous spikes over and over again. This really is par for the course in the crypto industry to see this wild volatility. And plus, if you do take that long-term view, it's the people who invested 5 years ago, they're seeing, even with where everything is today, a 70% annual rate of return. Those returns are what keep people coming back to this asset. And if you think about other countries outside the US where we've got a strong dollar, stable government, you have to deal with hyperinflation. If that's your alternative, you will see more people investing in crypto. So for example, in Argentina, this is in the Wall Street Journal just a few months ago, people prefer to have the volatility of these enormous swings both down and up compared to a guaranteed 40% loss to inflation. And so what we're seeing in a lot of developing countries or countries with hyperinflation is that this is becoming the fiat currency that people transact in. And there's even countries that have said, you can pay your taxes in Bitcoin, and we are now accepting it as legal tender. So adoption's going up. So despite all the headlines, we will continue to see adoption across the globe. So let's talk now, what exactly is this crypto asset? There's Bitcoin, which I think most of us are familiar with. But to understand crypto, you have to understand what is blockchain. And to understand blockchain, you have to understand what ledgers are. And to understand ledgers, you have to be an accountant. So luckily, we're all in the right spot here. So let's go back to the very first ledger. We're gonna go way back in time. Anyone know who the guy in the middle is there? Any guesses? It's not Galileo. It is Luca Pacioli, who is the founder of the double entry accounting system that we all just know and love today. And that's Da Vinci alongside of him. They're contemporaries. So he was the one. He's the one where that quote, "Don't sleep until the debits equal the credits." That's that guy. So a ledger is what you see right here. The very first ledger was just paper, and hopefully none of us do this, but this is what it was for thousands of years. Debits and credits, journal entries, jotted down, and of course, if this paper was lost in a shipwreck or in a fire or a storm, whatever, there goes all your books and records, right? Then in the 80s, along came Lotus 123, which revolutionized this, put it onto spreadsheets, and from then on, we all worked 9 to 5 jobs instead of long, crazy hours, right? Okay, maybe not. And so this, in the 80s, was just a revolutionary change. You could do so much more. You didn't have to worry about things footed. And all of your transactions were saved digitally. Now, at that same time, people said, well, hey, what if I want to password protect something? What if I want to share a file? The whole idea of connecting these transactions to each other is what it all started getting developed then. But there wasn't really a market from it aside from the Excel spreadsheets. But the idea of having a digital ledger that was distributed across a network of computers was invented back in the 80s. And it would be completely cryptographically insured, so that way no one could ever hit the undo button. And that's called when all those computers agree on what the spreadsheet is or what the group of entries should be, that's called a consensus protocol. And so this consensus protocol, what happens is each one of these computers holds a ledger, and as one of them proposes, hey, here's a new transaction that we want to write. And they'll all say, here, okay, in our next, we're all proposing these different debits and credits to this ledger. And when we post them all together, we're going to post them all in a single block. And once we all agree and come to consensus and say, yes, this is the next block, you write it then to this chain of different journal entries that have been made. And once it's written, and there's no way to undo or change things or go back and erase. And so, which is, of course, where the term blockchain comes from. So why this matters is in 2009, a mysterious person named Satoshi Nakamoto came out with something called Bitcoin, where it's this white paper statement that said, hey, we're going to turn all of these pie-in-the-sky ideas into an actual digital ledger and make this into a virtual currency. And the way that you would transact on it is you'd have all of these computers that were nodes on the network, and they would get paid rewards for essentially hosting the network. And if you wanted to make a transaction, all you have to do is have a wallet. And if you have a wallet, you can hold tokens in it, and you can transfer those tokens somewhere else. So what exactly is a wallet? A wallet consists of two things, a public key and a private key. The public key is an address, sort of like how you all have email addresses where back in the day you had to probably explain to someone, what does that little A with a circle in the middle mean? Like the email addresses when they first started, it was kind of like confusing, like what is this? But now everyone has one, right? Wallets are kind of the same way where it's like OX and then just this string of like 24 characters it's how it identifies your specific wallet on the blockchain. If you have that, then someone can transfer tokens to that wallet, and someone could also look up your transaction history. It's a public ledger. And the private key is what gives you access or control over the tokens that are in that wallet. And so I like to think of it as, with a car analogy, that the public key is sort of like your driver's license, your license plate, where anyone can look that up. It's public record, it's fine. You can look it up and see, oh, that belongs to a 2002 Harley Davidson or whatever. And you can learn a little bit about it, but it doesn't give you control. Whereas if you have the actual key to it, it doesn't matter if you have the title of that car or if you're the true owner. Whoever has the key is the person who's going to be able to move that car around or the motorcycle. And that's an important thing because we'll talk in a little bit about why private keys matter so much. So if you are thinking about investing in this, private key management is going to be one of the key issues that you need to think about as a CFO of how are we going to protect that and ensure that we have internal controls and safeguards. So far we've talked about Bitcoin. Bitcoin is great because, to some degree it's a hedge against inflation. It makes international transfers so simple. If someone lives overseas, this network of computers just lives everywhere. And so you can transfer, you don't need to worry about SWIFT numbers, routing, funds to settle, et cetera. You can transfer, and as soon as the next block is written to the blockchain, it's there. And if you think about, a lot of the planet and even this country, people don't have access to banks for whatever reason. And so with Bitcoin, now if you have an internet connection, you can actually move funds and increase your value and hold value safely over time. So that's Bitcoin, but there's so much more. In 2012, something called Ethereum came out, it was a young man named Vitalik Buterin who said, hey, why don't I take the open source code of Bitcoin, and on top of it, I'm going to make the ability to write a smart contract or write a program that will self-execute on the blockchain. And so what this did is it made it so that way anyone on the blockchain could then write codes that would say, if you wanted to, for example, borrow and lend, like let's say that you're really bullish on the price of Bitcoin or some token, and you wanted to get a loan peer-to-peer on the blockchain, you can now, without needing any bank or intermediary, you can just go straight into a contract on the code or on the Ethereum network and get a loan peer-to-peer. And you can create options, derivatives, and it's it's permissionless and it's self-executing. So kind of like how if you set up a trust, right? When I pass on, I want to make sure that my heirs get, this much money once they graduate from college. Well, you're going to need a trustee once you're gone to make sure that that actually happens, whether it's a bank or a trusted loved one. On the blockchain, it's all programs. It'll happen automatically no matter what. And this is huge because it has created an entire industry called decentralized finance. With options, derivatives, even legal entities are being set up today called decentralized autonomous organizations, where they say, okay, if you have this token, that the smart contract says anyone who has this token can now vote on decisions that this company will make. And so you guys might have seen about a year or so ago that a DAO almost bought an original copy of the US Constitution. People paid in all this money to buy these governance tokens, and then the creator of the DAO was using all that funds to bid in an auction to get a copy of the US Constitution. Then everyone would anyone who had that token then had a fractional ownership of an original copy. So wild and crazy things, and I'm sure you guys have heard, I guess raise your hand if you've heard the term non-fungible token. All right, yeah, just about everyone in here. I think it's one of the worst names in all of accounting, or well, I guess all of blockchain. Like we accountants, we call cost of goods sold the cost of goods sold, right? Like we have very nice, reasonable names. A non-fungible token is simply a token that is unique just all by itself. So if you think about it, if I had a dollar bill, right, and someone said, hey, I'll trade you $1 bill for another, I would say, great, doesn't matter, right? It's fungible. Now, if my dollar bill has been signed by Queen Elizabeth, right, then suddenly, hey, wait a second, that's something special. That dollar is no longer any other dollar. There's intrinsic value to that. And so the same is true for these types of tokens where that one token is unique in and of itself. And so if you think about applications in the real world, tickets to a concert. If I hold a ticket, that's going to give me on that day, at that venue, at that assigned seat, I now have access to that event. And so that is something that is ripe to be moved on to the blockchain. And there's companies that are innovating that. Even the Super Bowl, last Super Bowl, if you had a ticket, then you would actually get an NFT that was associated with yours. And so in some ways, not only is it great because the whole ticketing system can move onto the blockchain in a way that is verifiable and you don't have to worry about a fraudulent ticket. Is this person selling me a real one or not? It's authenticated on chain. You also have a digital scrapbook in your wallet then of every single event that you ever attended. I'm just getting everyone warmed up for Steve Young, who will be here next. And this does also include the overpriced JPEGs that you guys have probably heard of, the Bored Apes. There's companies, so each one of these JPEGs, even though I've got a copy of it right here, the quote-unquote original art is an NFT that people have paid hundreds of thousands of dollars or more for a picture like this. Pure speculation, but that's what it is. And if you think, well, that's just silly, that's ridiculous, who would actually pay money for this image, especially those absurd amounts? Companies like Tiffany's, the jeweler, it actually has collaborated with some NFT producers to say, hey, if you buy one of these insanely expensive NFTs, we will give you a real-life version of it in the form of jewelry. And they could authenticate because they say, well, yeah, it's an NFT. We know if you've got the wallet, then you're the person who gets this real-life thing. So we're starting to see this collision of the blockchain, kind of this pie in the sky, and then real-world application. And if you look at the companies who are getting into crypto, this is purely the amount of money that was made in last year just from NFT sales. So Nike is far and away the leader. They bought a local startup called Artifact, where they simply design digital Nike shoes. That's it. But they know that people are willing to pay a lot of money for these, especially with the idea of the metaverse is coming, and what am I going to be walking around in? And I can't have some knockoff Nike shoes. I want to have authentic wear, right? And so Nike has paid this company that can make NFTs for them of cool-looking Nike shoes. All these other companies here, we got Dolce & Gabbana, Tiffany's, which we already mentioned. Gucci, you can buy Gucci bags using ape coins. They accept crypto as forms of payment. And if you think, okay, yes, that's great. These are all just speculative, rich people things, but real world, like hardworking Americans, where does this actually come into our world? Well, if you think about in countries like Colombia, they are already starting to put their property deeds and plats of land on the blockchain. Because if you think about it, if you buy a piece of property, right, there's a county office or a clerk that somewhere says, okay, each of these plats has this, this number, and I can see the title is currently held by so-and-so, and the previous owner was so-and-so. Well, that is an industry that is ripe for being put on the blockchain because each one of those plats can now be turned into an NFT. And then if you start transacting like they're starting to do in Colombia on the blockchain to execute real-world transactions, well, you don't need title insurance. You don't need a middleman. If you transfer the NFT, the NFT is transferred. It's instant settlement, and it's been verified already. You know it's authentic, and done. And so an entire industry can now get collapsed just by this blockchain technology, and it's starting to happen. So let's talk about, real quick, Web3. I assume most of you have heard this. This is another term I don't like because when I first heard it, I thought, I must have missed Web 1 and Web 2 because I don't know what Web 3 is. How did we even get here? I've never heard Web 1. And so this is just a way of trying to sound cooler than we actually are. Web 1 is essentially the AOLs and Netscapes of the world where you can log in and click on static websites. And yes, you can see images and view websites, but that's about it. Web 2 is the world that we live in today, by and large, where you can now use the internet to interact, to buy things, to post content, to write blogs. And it's, by and large, everything that you post is owned by a big company such as Facebook or Netflix, Google. Like all of our personal information is kind of owned and controlled by them and monetized. Web 3 then, which is decentralized and it's just on the blockchain. There isn't a company that owns the code. It's maybe someone put it out there, but once it's out there, the governance then goes to all these anonymous individuals. It's kind of self-contained, self-owned. That means that if you were to interact on this, you keep everything. Those NFTs that you have bought and purchased, they are yours. So how do you make money on the blockchain? Specifically in decentralized finance. We'll just talk about some of the top ways real quick. First is mining and staking. So in other words, if you say, I'm going to be a validator and I'm going to be one of those nodes on the network, then you get those transaction fees people pay go to you. You can provide liquidity in exchanges. If you wanted to swap an ape coin for Ethereum or to some other token on the blockchain, you can now do that without needing a Coinbase or Crypto.com and you can go through a decentralized exchange. And just like if you go to the airport and you fly to the UK and you land, you say, oh, I need pounds sterling here, my dollars don't work. There's usually a money changer at the airport, right? And they've got all these different currencies kind of sitting in the vault in the back. And of course, they're going to upcharge you to swap out your money. It's essentially, you can now on the blockchain say, hey, I want to provide the tokens that are in that vault, and then I get a cut of all the swap fees. So that's another way that you can make money. There's arbitrage, as different liquidity pools have different fair market values. We're seeing high frequency trading coming into vogue on the blockchain where, hey, there's a discrepancy of the price of ETH between here and here. Let's trade and arbitrage those. Lending and just other kinds of speculation, just where you're pulling out the middleman, or NFTs and so on. So this is this whole market. If you look at this, I don't know if you can even read this, but Web3 and DeFi, this is over the last 12 months leading up to last June. You can see that Web3 and DeFi far and away took over or outpaced all other investments of venture capital. And this doesn't include when people do coin launches and raise funds that way. And if you think about it, the infrastructure is already there, like the blockchains exist, and you don't need to get licenses or permission. It's all permissionless. So the ability to scale and just see all of these technologies blossom and flourish overnight is really unprecedented. So let's go ahead and let's talk about, if you're going to get into crypto, how do you safeguard these assets? Now, there's a lot of headlines that is, I feel like almost every other week, it's the Ronin Bridge got hacked, or this big wallet got hacked, or this person was subject to a phishing attempt and they lost millions and millions of dollars of Bitcoin. Like every day, I feel like there's another headline that says something about a crypto hack. I would just like to clarify that when these hacks happen, it's not because the blockchain got hacked. It's not because the Bitcoin software, someone figured out a way to go back and rewrite the journal entries on the blocks. It's usually a error on a human where they lost their private key or gave it to someone else, or they didn't have proper internal controls, or in the case of these smart contracts, maybe someone found a loophole or a bug in the code that wasn't found earlier, and they exploited that bug. And so just want to, when you hear that the blockchain has been hacked, just know that it's not the blockchain, it's the people who were doing transactions on the blockchain. So how do you actually custody crypto if your company is going to get into this? There's really two options if you want to hold any crypto on your balance sheet. First would be through a centralized or custodial owner. This would be a third party who specializes in this industry. Retail options include Coinbase, Binance, Crypto.com. Celsius would have been on there. You can see I struck it out. And there's institutional grade custodians such as Fireblocks or Prime Trust and quite a few others. You can Google it. The institutional ones, so if you work for a family office or even if it's for your company business, right, these will have higher investment grade SOC reports and security with them. And the second option would be through decentralized non-custodial providers. And so you've got hot wallets, which are essentially just programs or software that works straight on your computer. Usually it's a widget in your browser. Or cold wallets, which is like an actual piece of hardware. And so I'll just show you a quick screenshot of what they look like. This is one that's most popular called MetaMask, which you can, if any of you wanted to get on the blockchain today, this is a way you could easily just download MetaMask, install it in Chrome, and then create a wallet for yourself and go off to the races. I wouldn't recommend it. It's technical. You need almost a computer science degree to use it, but it's there and it works. The other option would be something called, this would be a ledger stick, where in order to execute a transaction, you have to physically hold this device and either plug it into the USB drive or use a Bluetooth and say, yes, I authenticate it. And the difference between these two is that with MetaMask, your private key, well, I guess first of all, with a custodian, the custodians are the ones that are going to hold your private keys. And so as long as you trust that custodian, then you're safe. But in the case of Celsius, right, where it turns out, they ended up having to freeze assets, you don't have the private key, you can't make a withdrawal. They hold the key, you don't control it. And so with MetaMask, you never have to worry about someone freezing your assets, but your key is now on your computer. And so if you link to a bad website, or if you get a virus or something, then it can scan your computer and see if it can find your private key. Then tough luck, someone's going to drive away with your funds. The ledger stick is then the more secure. Your key only stays on the stick itself, but it's also more cumbersome because then anytime you want to make a transaction, where do I? Oh, it's at home. I'm at work, and so it's a little more. It's safer, but not quite as quick on the draw. So it's very popular, in fact, for people keeping large amounts of funds. Like they'll usually have their MetaMask as their hot wallet, where they have just enough to trade and execute transactions, but once they've made their money, they'll put it back into their ledger. And the ledger is much, if you have a lot of funds, then that's one of the most popular. So popular, if you look back at that original photo, I think even Luca himself had one. You can see right there. So shameless plug alert, where does Giddy fit into this? We are simply an app that allows you to stake straight into decentralized finance protocols today. So like those liquidity pools I was talking about earlier, you download the app and it is non-custodial, so you own your private keys, but our nifty solution is kind of the best of both worlds, where your private key gets split up amongst your different existing credentials. So for example, the device itself, your fingerprint, your Google, your Apple, and a PIN number on your iPhone. So if you have, your private key doesn't actually exist on your device, it's split up on the blockchain amongst these different credentials. And so someone to access your private key with Giddy would not only have to have hacked your Apple and your Google account, but they would also have to have your phone and be able to unlock it. So we like to say it's sort of a Harry Potter Horcrux kind of security system where, yeah, you can lose some, but as long as you have one, you can restore it and it'll never be totally lost. So let's talk about probably why everyone's here, which is if you do add some Bitcoin or any type of crypto onto your balance sheet, what do you need to think about as a CFO? Well, first of all, blockchain accounting is very difficult. It's very techy. It's not written for humans. It's written for computer scientists. And so luckily there's companies like our own local TaxBit or Bitwave, Coinly, ZenLedger. There's a lot of companies that are there that they will sync with NetSuite or QuickBooks or the most popular accounting software to take blockchain transactions and turn them into debits and credits within your current accounting software. But the accounting itself can be difficult. You'll need someone who, after this, hopefully most of you consider yourselves in this category, but you'll want to have someone who is accustomed or at least familiar with what is, a staking reward or yield or an airdrop, so on and so forth. Just someone who knows what they're looking at and knows how to report them. So the proper reporting right now is you report crypto holdings not like you would as a investment of stock or other assets, because they're not securities. You would report them simply as intangible assets. So even if you buy the right stock or the right token and it just goes all the way up, but guess what? You can't mark it up to fair market value and book some unrealized gain. You just keep it there like you would goodwill or something else. And only when you sell the asset and realize the gain could you actually recognize that on your financial statements. But the reverse is not true. If your stock tanks, then you have to recognize impairment loss. And you have to do that currently and test regularly and report that on your financial statements. I think that's FAS 102. You also need to think about internal controls. Which we've talked about already. How exactly are you going to custody this? Typically, if you have a company account, you're going to want to use what's called a multi-sig wallet. So that means that the one person couldn't just run off with all of your funds. Or, heaven forbid, someone gets hit by a bus or wins the lottery is probably a more optimistic way to say it, and they go and leave, then they can't run off with all your funds. Multi-sig means that you need to have sort of like the nuclear bomb, right? Or you need to have both people twisted the same moment, the same idea there. Also, ESG is huge. It's becoming more and more important every day. Bitcoin it's not the greenest. I read actually just this morning that there's an Australian company that is using a solar-powered Bitcoin mining facility. So there's that. And just last week, Ethereum switched from a very power-intensive consensus protocol to what's called a proof-of-stake protocol. We won't go into the details, but the bottom line is that it is 99.95% more energy efficient than it was before. And so when you're thinking about ESG and what's your carbon footprint, not all coins are equal, and so you'll want to take a look and see what exactly you're invested in and how it's generating that. AML and KYC, anti-money laundering, know your client. You don't want to get the blockchain is anonymous. Like there are companies that do analytics to help you find out who's who, but you don't want to do business with anonymous individuals if you're an institutional investor. That's just not allowed. And so you have to look and see what exactly you are and are not allowed to invest in, and what are the stakes there. Because if you just go into any DeFi pool and start staking, well, technically you could be investing alongside some North Korean hacker group that is funding a nuclear weapons program, and that would not look great if that news came out. Is there guidance coming from the FASB? Yes, last May they said, I guess we'll take a look and make some more details about it. And then they were quickly to say after that, but just so you know, we're not going to talk about stable coins or NFTs or a lot of the other stuff that really matters to you guys. So let's talk about, that's financial reporting. Let's talk about taxes. Is crypto taxable? The answer is yes, absolutely. But that's just Code Section 61. Gross income is from all sources, from whatever source derived. If you hold, it really depends on how you hold your crypto assets. If it's for investment, or if it's trading, then you would treat it as inventory. It's not currency, so foreign currency gain-loss rules wouldn't apply. It's not a security, and so the straddle rules or wash sales rules also are not going to apply. And we'll talk about we'll do a quick little timeline of what the government has said, and you'll find that this is pretty sparse. So we've got the creation of Bitcoin, 2009. It wasn't until 5 years later when the IRS said, here's some FAQs that we've been getting about Bitcoin. That yes, if you paid an employee in Bitcoin, you need to report it on their W-2 in US dollars, not in the price of Bitcoin. Make it easy for us, is kind of what they're saying. And yes, everything is taxable if you're making money. And in 2017, this isn't a tax thing, but there was a lot of initial coin offerings where just anyone who was doing anything on the blockchain said, hey, I've got a new token, it's worth trillions, right? And just all these tokens came online overnight, and the SEC came out and said, gosh darn it, those are all securities. You guys are just fundraising on the blockchain, but who cares? It meets all the rules of the Howey test. So then in 2021, just last year, Congress passed the infrastructure bill where it was over 1,000 pages of text, but somewhere nestled in the middle, they said, oh, by the way, anything that is a cryptographically ensured storage of value is considered a quote-unquote digital asset. And if you're facilitating trades, then you need to do 1099 reporting of those assets starting in 2023. With the whole idea of essentially making it, hey, we want to be able to tax this dang blockchain, and we're not going to be able to tax it if no one reports what the gains and losses were. And then today, just this year, we had over 58 proposals put into Congress that involve some digital assets one way or another. And Biden, the executive order of, hey, we need to figure out with each of our government agencies, how are we going to tackle this? Like, what does it mean for us? Should we do a central digital dollar like how China did the digital yuan? And the most notable there was something called the Lummis-Gillibrand bill that was doing nothing but tackling all these issues that we see today. I'll just quickly cover that because I think that there's a good likelihood of this getting passed into law, and it'll most likely get voted on this January in the next session. We're pretty happy with it because it's a bipartisan bill, and they called it the Responsible Financial Innovation Act. They could have called it the EVIL Act, eliminating virtual internet lucre, or the Scam Act, the scuttling crypto artifice money. But they chose instead to have a promising name like Responsible Financial Innovation. I like that. We're off to a good start. So they clarified 1099 reporting and also snoozed it until 2025, assuming it does get passed. There's also a de minimis threshold, so if you pay the person who mows your lawn using crypto and it's under $200, then you don't need to worry about figuring out what was your cost basis in those tokens that you just paid with. Those rewards from staking and lending, those are tax deferred until you actually dispose of the tokens, which really is just an accounting nightmare. We won't go into it, but just trust me on that. And if you wanted to make a donation to charity in crypto, right now, today, you have to use a certified valuation expert to say, like if it was over $5,000, then someone would have to sign off. But prices are readily available. The government realizes that, and it's all on the blockchain. So they said, no, it's okay, just use a public source. And there's a lot of overlap between the CFTC and the SEC in terms of who actually regulates this, and they are giving more power to the CFTC. And they're even telling states that you got to line up and make the money transmission rules a little more uniform. Because right now, if we want to transact in New York, we need a bit license, which is a whole rigmarole. Or if you want to transact in Montana, you don't need anything. You can just do whatever you want. So there's a lot of issues that I think this is really a great job of what the government's doing and is finally paying attention. But nevertheless, still kind of feels like the Wild West. I will give a shout out to Utah. I'm on the blockchain task force. They're the Blockchain and Digital Innovation Task Force. Our next meeting is tomorrow. So if any of you have ideas that you would like to share, and a task force basically comes up with proposals that a member of the state Congress or state legislature can then take and say, hey, I'm going to sponsor this and actually put it up to vote to get it passed into a law. So this is if you have ideas that you want to share of like, wouldn't it be great if in the state of Utah we could blank? Talk to me after. I'd love to chat and hear your ideas. But right now there's a lot of cool things happening, just like the legal entities for a DAO, those organizations we were talking about, having NFTs for your car, like your title and registration. Imagine being able to skip the DMV and being able to just do all of that straight on the blockchain. You could do a lot more peer-to-peer, and you would know someone actually did have the title. There's a lot of cool things, and accepting crypto payments is also coming because apparently they were getting a lot of payments from the cannabis industry, where they're legally not allowed to have a bank account because that's a federal thing, and cannabis is not legal. So they would show up in the tax department with literally $2 million worth of cash in these duffel bags and say, here's our tax bill, boom, here you go. And so they thought, we don't want to have dollars here, especially not this amount. And so why don't we accept crypto instead? And so that, anyway, long story short, Utah's always at the forefront of innovation. They're listening, and I'm excited to be on that. We've got a little bit of time for Q&A. If you want to add me on LinkedIn, I don't know if that QR code will work. Hopefully it does. And if you're interested in the Giddy app, again, another shameless plug. We're just beta testing right now, but we'll go live next month. I'll pause now. That was a lot of me and my voice. Any questions from you guys? Yes, in the back. Impossible. It's impossible. So it's the kind of human version of a private key is a 24 set. It's a set of 24 random words that you would have to guess. And so I think I looked like if you were to try and brute force a private key, it's like it would take 1 trillion years or something like that. And so yeah, it's unfortunate, and there's a lot of sad stories online of people who said, I bought a bunch of Bitcoin and it went down and I thought, oh, who cares? And now it's worth, millions, but they don't know what they did with their private key, and it's tough. So make sure we can talk out if you're interested. There's ways that people have of backing them up. But yeah.
Same thing, but like you're talking about land deeds, car titles, owner dies, how's that land transferred? And just the land doesn't disappear.
Yeah, so that would be, this is where we need to get the state government involved. With smart contracts, this is where you can start having more fun and having a little bit more control over different assets. So for example, there are some token issuers, like there's a company called Circle who has issued a stable coin that's backed by the US dollar. And they're audited, they're venture backed, they're US based, like they've got funding with BlackRock, so they're a very legit company. But they know that if people are using this for nefarious purposes, we need to be able to freeze. And so Circle has a way of retaining control of those assets and making sure that if these go to North Korea, to a terrorist group, or to Al Qaeda or whatever, they can actually say, hey, those are all locked. And so if we can get the state government savvy enough on the crypto front, then you can have a way of everyone can own those titles and hold them in their wallet, but you still have a backdoor of the government could, like if someone were to pass or something, someone gets hacked or something like that, the government can still intervene and help out. Yes, over here.
When you see actual companies compensating employees with crypto, and if so, what platforms they're using, how they're actually doing it?
Yeah, so I guess two things. So one, yes, in fact, we have paid people with crypto. Most of them have been contractors. And it's interesting, like some will just, they want to get into crypto and they never have. And so the way we'll do it is we will just literally transfer crypto straight to them and say, here you go. And so if it's just an independent contractor or a vendor that's another business, pretty easy. You just transfer them money and that's it. And maybe you do need to, if it's over $600, there's probably some 1099 reporting that might apply. You would express it in the US dollar value at the time. If it's an employee, there are a number, I don't know the names off the top of my head, but I do know that there are companies right now today that are doing crypto payroll. And so they will handle, transferring all the funds into that person's wallet and then handling all the back-end W-2 and W-3 reporting. Great questions. Over here.
So I've heard Fidelity is getting into this space where you could put some of your 401k funds towards coins. Do you see the other financial institutions jumping on board with that?
Oh, absolutely, absolutely. And it's funny, so Goldman Sachs even is using crypto, like blockchain technology, just to settle transactions. I'll go in there in a second. Yes, absolutely. And our company uses Betterment for our 401ks, and tomorrow there is a webcast about how to put crypto into your 401k account and what it means. So yeah, it's a great idea. And I forgot what I was going to say. Oh well, we'll come back to it. Any other questions? Are we out of time, John?
We can do one more.
All right, we'll do one more. All right, right here.
How did the industry at large get into investing in crypto? And to me, cryptocurrency it's a foreign currency.
Mm-hmm.
How there's nothing you're investing in. It's there.
Yeah, yeah. So it kind of goes back to one of those. I think one of the most common questions about crypto in general is like, well, why does a Bitcoin have any value? Like we looked at that chart of like the market cap, and even today it's like trading at 19 or 20,000. Like, why would anyone even pay for that much for it? It's crypto sort of makes me have to understand, like instead of just driving the car around, I feel like I have to look underneath and understand all the alternator and where the transmission is, and like that. It sort of caused me to rethink our whole financial system. And it's, why does gold have any value, right? It's kind of the same idea of just, well, it's something that you can't, there's a finite amount of it, or at least a controlled amount. And it's something that if you hold it, you have the ownership, and it's not going to rust or melt or something else. It's a store of value. And so all those same things that make gold valuable also apply to Bitcoin and a lot of these other things. And so from there, then it's just the speculation of maybe a lot of people think the price is going to go down, or companies start adopting it and they want to transact in it, or there's some other value that they see where they need to gain access to be able to pay someone overseas. I don't know if that answers your question or not, more or less. All right, well, I think that's it. I think I'm out of time. Appreciate everyone showing up, and yeah, if you want, I'll just be over here somewhere, and feel free to chat after.